today we are digging into Leonardo DRS Inc., a really key player obviously in the aerospace and defense sector. And, well, their recent performance has been pretty remarkable, marked by some significant strategic wins and, frankly, impressive growth.
Right. That foundational strength is hard to argue with. But, that's what creates the central tension for investors right now, I think. The critical question really is, does Leonardo DRS's proven operational strength, its alignment with, these escalating defense priorities and that really impressive historical growth, does it actually justify the premium valuation multiples it's commanding? Or does the significant spread we see in intrinsic value estimates kind of warn us that the stock might be priced for perfection, leaving, no room for error?
Okay, so I'll be taking the more bullish position here. My argument is fairly straightforward. The company's strong fundamentals, its clear strategic niche in, critical defense tech, and its demonstrated execution, well, I believe that warrants the market's enthusiasm and justifies the current valuation.
And I'll be presenting the counter-narrative. My view is that the high valuation multiples, especially when coupled with certain internal signals, things like the persistent insider selling we've seen, and some critical operational dependencies, they introduce a significant element of fragility into the current share price that I think investors really need to weigh carefully.
Okay, so let's start by maybe establishing why the market is paying this premium. I mean, the company is in exceptionally good financial health. We're not looking at some speculative growth stock here. This is a defense contractor with a remarkably clean balance sheet. Its debt-to-equity ratio sits at only 0.18. That gives them significant resilience, right? And flexibility for future investment. Liquidity is also, it's not an issue. The quick ratio is 1.63. Current ratio is 2.0. It means they have a strong buffer to cover any short-term liabilities.
Mm-hmm.
But, financial stability is only half the picture. The growth momentum, it's really quite something. Sales year over year, trailing 12 months, grew 12.27%. And their earnings per share surged by 33.16%. Now, these aren't just like one-off bumps. This is demonstrated operational leverage, and it's contributing to a trailing 12-month income of $265 million. Strategically, they are, I'd say, laser-focused on high-growth, high-priority areas, advanced sensors and computing, naval modernization, counter-UAS capabilities. You see that evidenced by recent contract wins, the rollout of their SageCore AI platform. They've also set pretty ambitious long-term targets, aiming for organic revenue growth of 4 to 7% and an adjusted EBITDA margin of roughly 14% by 2026. Execution's been superb, frankly, and I think the market is pricing in a high probability they'll achieve those goals.
Okay, that is a very compelling snapshot of operational excellence. I'll give you that. But we just can't divorce that performance from the price investors are being asked to pay for it. I look at those same metrics, and then I look at the valuation, and honestly, I see investor euphoria baked into the stock. The trailing PE stands at a substantial 36.12, and the EV/EBITDA is 22.05. Now, for a company operating mainly in the industrials, or specifically defense sector, these multiples are, let's say, highly elevated. And the deeper problem, I think, lies in how independent analysts are viewing the intrinsic value. When you run rigorous models, like the free cash flow to equity model, some suggest a fair value as low as $23.49 per share. The alpha spread base case DCF, that's estimated around $27.60. So if the market's currently trading around, $35 to $36, that implies the stock is overvalued by, 25% or potentially more, depending on which model you trust. This kind of divergence between the operational reality and the price expectation, that's the definition of fragility in my book. And furthermore, we have to consider the internal signals. The C-suite, right? Including the CEO, CFO, and COO. They've executed numerous proposed sales and exercises throughout 2024 and 2025. That has to introduce some skepticism regardless of the overall ownership structure.
Right. You're highlighting the immediate sticker shock of that trailing PE. And fairly so. But I would challenge the sort of reliance on purely backward-looking multiples when you're evaluating a defense technology innovator. I'm just not convinced that a PE of 36.12 is an insurmountable hurdle when we're forecasting this level of growth. The market is, forward-looking, and that's why we see the forward PE dropping quite substantially, down to 28.20. Now, that's still high, yes, I can see that, but it anticipates the projected EPS growth next year of 15.40%.
Mm-hmm.
We need to compare Leonardo DRS not just to traditional industrials, but to its specialized defense technology peers. The market is willing to pay a premium for proprietary, high-demand IP in areas like advanced sensing and real-time threat detection. And, discounted cash flow models, as rigorous as they often struggle, I think, to capture the sort of exponential value potential driven by multi-year defense IP contracts and, frankly, strong government funding tailwinds.
I'm sorry, but I just don't buy that the current pricing leaves any margin for error, even if we account for strong future growth. We can actually use a growth-adjusted metric here to measure this expectation, the PEG ratio, price earnings to growth. It sits at 2.50. Now, just to put that in perspective for listeners, given the EPS next 5-year growth estimate is around 14.43%, well, a PEG of 2.50 signals that we are currently paying $2.50 for every single dollar of future growth expected. Historically, right, a PEG above 1.0 is often considered fully valued, and once you get above 2.0, it starts signaling significant overpricing. So a ratio of 2.50, it suggests those aggressive 2026 EBITDA margin targets must be hit flawlessly, or we risk a pretty swift derating of the stock.
However, the structural stability of the company provides, I think, some insulation against short-term volatility. That high insider ownership, sitting at 72.07%, is overwhelmingly driven by the parent company, Leonardo S.p.A., which holds, 71.77% of the stock? Now, this isn't just a high insider percentage. It represents a deep strategic alignment with a major global defense conglomerate's long-term vision. And that relationship ensures profound strategic stability, access to capital, international partnerships, things that independent contractors just don't have in the same way.
That reliance on the parent company certainly provides maybe a floor for stability, sure. But we have to circle back to the signals coming from the independent executives. I'm just not convinced by the argument that those sales are simply routine liquidation. I mean, while the net insider transaction figure is mathematically minimal at, negative 0.06%, the pattern of transactions is what's revealing here. When you have the C-suite, the CEO, the CFO, the COO consistently exercising options and executing proposed sales across many months in 2024 and 2025, and at price points ranging from $30.55 up to nearly $46, well, that acts as a tangible ceiling on investor excitement, doesn't it? Regardless of the parent company's static majority stake, these frequent executive sales signal that the key operational leaders themselves, they seem to view the current stock price as opportune to monetize. That suggests they don't see massive undervaluation from these levels.
Okay, that executive selling pattern, it absolutely warrants continuous monitoring, I agree, and it does introduce a sentiment overhang. But let's focus back on the fundamental operational resilience for a moment, because that's really key to sustaining the valuation. The defense sector, it requires multi-year predictability, right? And Leonardo DRS is actively working to secure its long-term revenue base against volatility. They are securing massive contract wins. The U.S. Army's advanced vehicle-based power generation capability, that recent counter-UAS competition win, international teaming agreements with organizations like KNDS. This bolsters their $3.57 billion in TTM sales and provides significant stability against, short-term economic shocks or component price fluctuations. And they are focusing on innovation, which at the end of the day is the ultimate mitigant against margin pressure.
Contract wins are great, yes, but operational resilience hinges critically on the supply chain. And here, I think, is a major point of vulnerability. That dependence on critical materials like germanium for their advanced sensing products, germanium is absolutely vital for infrared sensing tech, which is, let's be honest, the core strength of that segment. This is explicitly flagged in their earnings materials as a cause for potential margin pressure, and it connects directly to, geopolitical risks involving foreign mineral supply chokeholds. How can we confidently project that ambitious long-term margin target of 14% by 2026 if this critical input remains a vulnerability that is largely beyond the company's direct control? I mean, a material shortage or a significant price spike could instantly erode that projected margin growth, the very growth that high 2.5 PEG ratio demands.
The company is actively addressing this. They're reporting, quote, steady progress on strengthening germanium supply. You know, active supply chain management is what distinguishes a strong contractor in the space.
Okay.
But more importantly, I think their strategy is moving them beyond just mere component dependency. Their investment in innovation, particularly the deployment of the Sage Core AI software platform for real-time threat detection, this fundamentally shifts their value proposition. They're moving up the value chain toward high-margin proprietary systems and software integration. And that means their competitive edge increasingly relies on AI algorithms, system integration expertise, IP, rather than solely on the cost and supply of raw materials like germanium. This technological advancement, I believe, provides insulation and justifies the confidence in that 14% margin target.
Look, the technological edge is certainly their strongest asset. I won't argue that. But the market still has to reconcile this fundamental operational strength with the valuation that, according to many professional DCF estimates, suggests the stock is significantly overvalued, certainly in the mid-$30 range.
Look, Leonardo DRS stands as a robust defense contractor. It's benefiting from strong geopolitical tailwinds, increased allied defense budgets. That's driven impressive historical performance, including that staggering 423% performance gain over the last 5 years. So while the valuation appears rich, maybe based on backward-looking metrics, I maintain that the company's clear strategic alignment with crucial technological domains and its demonstrated execution, well, they warrant the premium, assuming they meet those ambitious 2026 targets.
And I'd say investors just need to weigh that operational excellence against the critical supply chain risks, particularly inherent in their advanced sensing segment, and also against the clear, consistent signal of risk aversion that seems to be coming from management's own share sales.